There is one red flag that market participants are watching very, very closely, but there's a lot of debate over whether it's actually a red flag. And I'm talking about yield curve inversion. That is when the longer end of the curve goes lower than the shorter end of the curve. We saw a very brief blip of an inversion in yesterday's session, according to some feeds. And so that reignited the debate, which is already going on, about what it means, whether it does indeed signal a recession. Is that the correct signal? Is it the right part of the curve? There's a lot of different aspects to this debate. Let's bring in someone who has weighed in on it. That's Michael Darda. He's chief economist and macro strategist at MKM Partners. Mike, it's good to see you. So I don't know which part of the question to ask you first. Well, I guess, is this the right signal? Should we be looking at the spread between 2s and 10s as a harbinger of recession?
I don't think so. So we have some of these so-called belly of the curve measures either getting very, very flat. 2s to 10s is dead flat. As you mentioned, inverted temporarily yesterday. I think it's at 7 basis points this morning. Some have been pointing to the 5-year relative to the 10-year. The problem is that those belly of the curve measures are really not reliable. They've inverted in the past. You don't always have a recession afterwards. What you tend to see essentially before every recession is the T-bill yield or the Fed funds rate up above longer-term rates on the curve. And not only do we not see that, but those measures have actually been steepening, not flattening, but steepening this year. The New York Federal Reserve maintains a recession probability model based off of the 10-year yield relative to the T-bill rate. And that model has only about 2% recession risk over the course of the next year. So the inversion eventually will come, and so will the recession, but there's no reason to front run it at this point in time, in my opinion.
Michael, is the market too calm?
Well, it's been volatile this year, right? We had a legitimate correction after not having had one for quite some time. And now, risk assets have been melting back up. And so, this period of volatility would certainly make sense based on the fact that long-term interest rates are moving up, and, that will tend to lower valuations. And it did until just recently, and now we have a recovery of sorts underway in risk assets. We'll see how far it goes. There are some parts of the market that we like, that we're bullish on, but overall for the S&P 500, I think equity markets are going to struggle this year. Not a bear market, not a recession, but probably not going to see gains anything like what we saw last year, for example.
So, Mike, sorry, I want to come back to the yield curve topic for just a second. So if different parts of the yield curve are showing different things, like what do we then key in on? And obviously, we've got some economic data this week, so things could change further. But what are we what should we be looking to take our cues then?
Yeah, so I think what you'd want to look at with the yield curve as a recession forecasting signal is the T-bill rate getting up above longer-term rates across the curve. And that's not happened. There are pretty large and even widening gaps between the T-bill yield, which is a proxy for the Fed funds rate, under essentially the direct control of the central bank, where the other rates on the curve are not. And so it's essentially a binary signal. It's either there's an inversion and you have recession risk, or you don't. And so what we've been telling clients is, let's cross that bridge when we come to it. And we're not quite there yet. We can also look at bond market inflation expectations measures. So if the Fed has gone too far in its tightening, those expectations would be weakening or at low levels. Instead, this year, they've been strengthening. In fact, inflation expectations up over a 5-year horizon have risen more year to date than the Fed's raised the policy rate so far. And so, we have evidence that the Fed is actually falling behind the curve so far year to date. We can also look at other credit market signals, like the spread between yields on risky credits like junk bonds and the Treasury market. Usually going into an economic storm, recession, big slowdown, you'll see those spreads widen pretty significantly. There's just nothing going on there. I think the real story is that despite the equity market volatility we've seen year to date, credit markets are quite quiescent. No real tightening in credit market conditions whatsoever. And then lastly, we can watch metals markets. Typically going into a period of economic weakness or recession, you'd expect metals to really weaken. They've been rising year to date, in a pretty sustained fashion. And so I think if we take a broad inventory of these financial and credit market signals, we don't have near-term recession risks. That will come at some point with the Fed behind the curve. It's going to be difficult to engineer a soft landing, but we don't want to prematurely front-run a recession call that's not staring us in the face here.
Yeah, I mean, and if indeed the Fed is behind the curve on controlling, on tightening too much, but also on controlling inflation, how are you thinking about the sort of consumer resilience in the face of this inflation? I mean, it's all anyone, sort of in layman's terms is talking about, right? For, not just market people like us, but like everyone we know is talking about inflation for a change. And yet it doesn't seem to be yet crimping growth. So why do you think that's happening, and how are you thinking about that?
Yeah, I think one explanation is the fact that we've been in this, rapid V-shaped economic boom. You guys were just talking about the labor market numbers. So we've had a rapid return to full employment. Even though wages are now lagging inflation, we've had very strong growth in incomes. And so if you look at the February data, and we'll get March data on Friday, if you multiply hours worked by wages paid, that's a proxy for incomes, even for non-supervisory workers, so middle to lower income folks, annualized at 12% in February. Now, unfortunately, the CPI annualized at 10%, right? So we have inflation eating up a lot of income growth, but there are resources to spend. And so there's a difference, I think, between what folks are saying, which is we see a lot of grumpiness and agitation about inflation in the consumer sentiment surveys, and what they're actually doing, which is that they have jobs and have incomes, and the money is being spent and put to work in the real economy.
And Michael, jobs report on Friday. If it beats expectations, does the Fed hike rates 50 basis points, and does that spook the markets?
I think they're probably going to do 50 basis points at the next meeting. I don't know how contingent on the number beating. I mean, unless we had like a disastrous number, I think there's a broadening recognition that they've started off from behind the curve. And so I do think they're probably going to make that 50 basis point move, absent some shockingly weak data, which we don't expect.
Well, we're all looking ahead to Friday then, and then to the Fed beyond that. Mike, good to see you. Thanks so much for being here. Michael Darda, Chief Economist and Macro Strategist at MKM Partners. Appreciate your perspective.